Okay, now for the second part of our recorded lecture, I'm going to talk to you more generally about ratio analysis. So we've done horizontal and vertical analysis in the first part of our lecture. Let's now look at the second part of lecture 2, which is to focus in on ratio analysis. Now, there are a plethora of different ways you might think about ratio analysis, guys. There are liquidity, solvency, and profitability ratios are three broad categories of ratios that generally cover all the ratios there are, or the vast majority of financial ratios there are to analyse financial statements. But I'd like to stress that you'll pick up different textbooks and they'll subcategorise ratios differently. They'll have different terms. Don't worry about it. The main issue really is the main issue here is the general understanding that there are ratios associated to your liquidity and solvency, that is your ability to continue existing and pay your bills and meet your debts, and how you're structured and your leverage position, all that sort of stuff. And there's ratios around your profitability, how well you're performing, independent of whether you've got cash or that you can survive. And, how well are you actually performing, and how profitable are you? Now, we're going to look at solvency and liquidity first. Can you survive? Are you paying your bills? What's your debt structure versus equity? We'll talk about all that first, and then we'll jump into profitability ratios for lecture 3. Now, liquidity ratios really measure your ability to meet your immediate cash obligations. The extent to which a business is able or unable to pay its immediate obligations, to pay its liabilities, its interest owing, its general bills, pay its staff, the extent to which a company can do that, and to a large extent this will apply to your entrepreneurial ventures. You will be struggling to make ends meet and to pay the bills in your early months. Let's hope not early years. Let's say early months. That's going to really cause you to really think about how you manage your cash, how you pay your bills, how you negotiate with suppliers, do you have enough to literally survive? That's liquidity. And that's why you should care about these ratios. Now, a bank, when it lends you money, wants to know you'll pay interest at least, that you're good to eventually repay the loan. Most importantly, that you've got cash to pay it. Whatever your profitability, if you're earning all these revenues but no one's paying you, it's all earned on credit, it's all accounts receivable, then the bank really doesn't care. The bank wants you to pay them back their loan with interest. And so a bank, for example, might care about liquidity as much as profitability. So liquidity ratios assess the ability of a company to meet its short-term financial obligations. You being unable to do so could result in your bankruptcy and legal ramifications, going to courts. It gets serious. It goes beyond accounting. If you can't meet your payments, it gets legal. And so clearly these are important ratios to understand and manage. I've introduced 4 ratios for you to think about in relation to liquidity: the current ratio, the quick ratio, the receivables turnover ratio, and the inventory turnover ratio. Let's start with the current ratio. Now, these 4 key ratios are commonly used to assess liquidity, but do understand that there's no one ratio that's better than the other. Rather, they work in tandem to collectively give you an overall picture of your ability to meet your payment obligations. The current ratio is our first and probably most popularly used ratio going around. It's one of the most frequently used ratios in financial analysis, as I just said, and it's simple. I've got to say, it's very simple. It's your current assets divided by your current liabilities. What are your current assets? They're all the assets that you expect will give you a future benefit within 12 months. What are current liabilities? They're all the payments you've got to make within 12 months. So to the extent that your current assets increase your capability to have cash, to pay your current liabilities, the current ratio is a very nice measure. Ideally, you want your current ratio, current assets divided by current liabilities, to be more than 1. That is, your current assets to exceed your current liabilities. A higher ratio, generally, in a mathematical sense, represents greater liquidity, a greater ability on your part to pay your debts. Now, why don't we take an average of current assets or an average of current liabilities? Now, I just want to stress something here. The reason we don't take an average of current assets and current liabilities is because of the shorter period in which they come due. We generally say, look, your balance at the end of a period is pretty much the balance you're good for, whether current assets or current liabilities. So we generally don't take an average of current assets or current liabilities. There's nothing stopping you from doing it, but as a general measure, we don't. From our My Financial Reports, guys, you can see current assets are $480 million, current liabilities are $531 million. Divide current assets by current liabilities and you get 0.904. Now you might think, gosh, that's kind of concerning. My current assets aren't enough to pay my current liabilities. Should I be worried here? Yes and no, and here's where it depends on the nature of your business. Generally speaking, yes, you'd like to have the current assets there, knowing that they're going to eventually give you a benefit, much of which will allow you to pay your current liabilities. But you may also be aware of the fact that you're a high turnover firm. You may be aware that you've got an injection of cash funds coming. There are a whole bunch of other factors that might drive your concern or lack of concern for the level of your current ratio. But I do acknowledge that, ideally you'd like your current ratio to be greater than 1. The quick ratio is a stronger test of the current ratio. Having sung the praises of the current ratio and talked to you about how widely it's used and why it's beneficial and how important it is, I'll now dump on it a bit. I'll criticize it. If you think about what your current assets are in your balance sheet: cash, accounts receivable, inventory, prepayments, if you think about it, the idea that all those current assets turn into cash and help you pay your current liabilities is an assumption we might quite readily question. Let me give you an example. If the logic is current assets help us pay current liabilities, well, prepayments don't really help you pay your current liabilities. If you have prepaid insurance, prepaid rent, they don't help you pay your liabilities. They just stop you from having more liabilities. But the liabilities that are already in there as current liabilities, your prepayments don't help you pay them off. Inventory is the same. You could take a long-term loan and stock up on inventory. Doesn't mean you're going to sell it, get cash, and pay your current liabilities. So there are a whole bunch of current assets like inventory and prepayments that are current assets. They do give you a future benefit, but with prepayments, the future benefit isn't cash, which helps you pay your current liabilities. The future benefit is the avoidance of paying cash. It's not the creation of more cash, and that's fundamentally different. For the current ratio, that doesn't give you more cash to pay your liabilities. It just stops you from having to pay more cash. Now, when you've got current liabilities you've got to pay, it doesn't change the fact that you've got to pay them. So your prepayments don't actually give you cash to pay your current liabilities. Now, they are an asset, but they're not a cash generating asset for the purposes of paying current liabilities that are in your balance sheet. So they don't really do what the current ratio hopes you do. So perhaps prepayments don't really help us pay our current liabilities. Now, what about inventory? You might buy inventory, as I said before, but you may not sell them and earn a return on them. It's not a given that customers are going to buy all your inventory. Not all of us are Apple. Folks don't just line up to buy our stuff. From this point of view, do you really want to count on your inventory as a source of current assets? Are you really sure you're going to sell them all and have the cash from them to pay off your current liabilities? To the extent it's a 50-50, you may well be skeptical of inventory in its ability to guarantee you cash to pay your current liabilities on top of what you already have. So we exclude, typically, we get skeptical of inventory and prepayments. And that's why we've got the quick ratio. The quick ratio takes out all the current assets that you might think, I'm not sure if they're going to help me pay my current liabilities, and leaves the very, very liquid current assets like cash any short-term monetary instruments that you can just sell off on the stock market and get cash, short-term bonds, etc. And accounts receivable. The theory here is that if you sell something to someone, you only sell it to them because you expect them to pay you back. Bad debt percentages don't tend to go much beyond 3 or 4%. If they do, you've got a problem, a fundamental problem. Most companies don't have bad debts that are material. So if you've got accounts receivable, you expect to get the money back. You expect it to become cash. Now, therefore, the quick ratio, we take cash, we take short-term monetary instruments, and we take accounts receivable. But we exclude 2 current assets, specifically inventory and prepayments. Now, we then divide these very, very liquid current assets, cash, accounts receivable, short-term monetary instruments. These very liquid cash assets, current assets, we divide them by current liabilities. The same current liabilities we use in the denominator of the current ratio. So you can see what the quick ratio is. It's really a stronger test of your current asset, your current ratio. The quick ratio takes your really liquid current assets and divides them by all your current liabilities. So you can see in this formula here, cash and short-term investments are $74 million in the Maya financial statements. Accounts receivable is 17 million. Why is it 30 minus 13? If you look in the notes to the financial statements, you'll notice that there is a $13 million inventory prepayment figure which we've excluded from the 30, leaving $17 million. So I'd just like to stress that this is a much stronger test of accounts receivable, of your ability to pay your liabilities as they come due. Very, very good companies have quick ratios that are less than 1. You know, GE in the US has a quick ratio far lower than 1. It's not necessarily a bad thing to have a quick ratio less than 1 because it's such a strong test. Maya, look at Maya's quick ratio. It's 0.17. You know, why is it that low, and should they be worried? Well, probably not. They may well have concern, but they may not be worried. When you consider an organization like Maya's very high turnover, the inventory does get sold, it does become cash. And so the quick ratio might be a very harsh test on a firm like Maya. Lots of good companies have quick ratios less than 1. Don't panic. Reflect more on the fact that your inventory, will your inventory actually get sold? If it will, yeah, it doesn't matter that a quick ratio excludes it. You know the current ratio. You trust it. And so in that sense, the quick ratio is a stronger test of your ability to meet your obligations than the current ratio. The third ratio is the receivables turnover ratio. The receivables turnover ratio compares a company's credit sales in a period and divides it by its average accounts receivable. Why would you do that? Well, the higher your ratio, the better your ability to collect sales revenue. If you think about it, if you've got, say, all this credit sales, but your accounts receivable balance on average for the period is really low, you obviously collect on accounts receivable well. You've got all these credit sales. Folks are buying on accounts receivable, not paying cash. Yet your average accounts receivable at the end of the period is low. Now, that's a sign that you're getting people to pay you quickly. But if you don't have a lot of credit sales and your average accounts receivable is huge, that means that folks aren't paying you and it's just accumulating in accounts receivable, but no one's giving you cash. So the higher your numerator, the higher your sales revenue, and the lower your average accounts receivable, the greater your ability to collect your accounts receivable. The higher your receivables turnover ratio, the better your ability to collect cash from credit customers. Now, you can see in this question, our sales revenue is $3,143. Our average accounts, $3,143 million, which is $3.143 billion. Our average accounts receivables, guys, is $15.336 million. How do I calculate that? It's the beginning accounts receivable at the start of the year, the prior year's accounts receivable, plus the ending accounts receivable, divided by 2. Now, please understand that average accounts receivables are only used because we want to reduce the volatility of the ratio. If I take ending accounts receivable, just that one ending number, I give an incentive to organizations to manipulate numbers in the last minute to make the accounts receivable turnover ratio look good, the receivables turnover ratio look good. By taking an average, it's harder to manipulate the number. What's an average? It's the beginning balance plus the ending balance divided by 2. Now, the inventory turnover ratio tells us, proxies the ability of a company to sell its inventory and to manage it well. Let's again think about the logic. I'll show you the formula. It's cost of goods sold divided by average inventory. Again, what's average inventory? It's your beginning inventory plus your ending inventory divided by 2. Beginning inventory is the inventory balance at the end of last year, because the end of last year becomes the start of this year, and ending inventory is the inventory balance at the end of this year. Beginning plus ending divided by 2 is your average inventory. So the formula for inventory turnover is cost of goods sold divided by average inventory. What's cost of goods sold? It's the total cost of the goods that you've sold this period, the cost price of the goods you've sold this period, the total. Now, let's use an extreme example. Think about what it means if the numerator is really high and the denominator is low, or the numerator is really low and the denominator is high, and you start to make sense of a ratio. If I've sold heaps of stuff, if my cost of goods sold is huge, right, I'm selling loads and loads and loads, I've got billions in cost of goods sold, but my average inventory balance, I'm holding inventory, say $10. Literally, think of an extreme example. My average inventory is just $10. And I'm making billions of dollars in cost of goods sold. I'm selling, right? What does that mean? It means that I'm selling a lot. And inventory is just coming in and going out. It's coming in and going out. It just doesn't stay in my firm. The moment it hits the shelves, it goes out. I am a business that can't get enough stuff. As soon as I get something, it's sold. I don't hold any inventory, and I'm selling bucket loads of it. Inventory just doesn't stay in my store. It comes in, it goes. That's a sign of a healthy company selling a product that's in demand. Think about the reverse. What if your cost of goods sold is really low and your inventory holdings are huge? If your cost of goods sold is really low, the first sign is that you're not selling a lot. You haven't got a product that's popular. And if your inventory is really high, it means, well, you're stockpiling. You're buying all this stuff that no one wants to take off you. You're just holding it. It's a sign of a company that manages its inventory really badly. And it's a sign of a company that just isn't selling enough product. It's generally not a good sign. The higher your numerator, the lower your denominator, the better this ratio. And so inventory turnover is a measure of your ability to manage your inventory and your ability to sell your inventory. We now go to solvency ratios. Solvency is more about how liabilities and owner's equity in organizations are structured to fund assets. They're crucial in helping us understand our capital structure. Solvency is your ability to remain in business over the long term and satisfy the long-term obligations of your stakeholders. It's related to liquidity, but while liquidity is short-term, can I pay my bills? Current assets divided by current liabilities. Solvency is a longer-term picture of your general risk position. If you're a business that's 90% funded by debt and 10% funded by owner's equity, well, that's kind of a risky position to be in. You're highly leveraged. Solvency answers questions like this. And as I said before, guys, while liquidity tells you a short-term story about your ability to meet your obligations, solvency is a medium to longer-term story, focusing on a company's capital structure. Financial leverage is a big concept that solvency delves into. To what extent are you reliant on debt to fund your operations as opposed to owner's equity, your own money? What's the right level? It's a very hard question to answer. The more leveraged you are, the greater the potential for your returns. If you put $10 into a business and you get $1,000 of debt, well, for putting $10 into a business, I don't know why someone would give you $1,000 of debt when you've only put 10 in, but hey, good luck to you. Must be a great idea. Fantastic. You've got $1,010. If you make even a profit of $10, that's a return on equity of 100%. You put $10 of equity, you got a profit of $10. But because you got $1,000 in borrowings, $10 of your own equity, $1,010, you've got assets of $1,010. Making $10 in profits from assets of $1,010 shouldn't be too hard. Yet that gives you 100% profit because you only put $10 in as equity. Now, that sounds great. We should all leverage to the hilt, shouldn't we? No. Because if you make a loss, it's ugly. If you even make a loss of $10, you've lost all your equity. That's the risk with being leveraged. So leveraging and risk are two very connected ideas. And that's why solvency is a nice ratio. It tells a nice category of ratio. It tells you about the risk profile of a fund. Now, there are three main solvency ratios I'd like to expose you to. They are debt to assets, debt to equity, and times interest earned. Let's go through them. These ratios generally tell you a story about leveraging, as I've said. And yes, generally the more leveraged you are, the more concerned you might be in relation to debt to assets and debt to equity. But you'll see, it's not always the case. It really comes back to the style of company. Let's now think about debt to assets. The debt to assets ratio is your total assets, total liabilities divided by your total assets. In the Meyer example, your total liabilities are $1,039 million and your total assets are $1,933 million. Divide total liabilities by total assets and your debt to assets is 53.75%. Debt funds 53.75% of your assets. If liabilities, debts, fund 53.75% of your assets, how is the other 46.25% funded? Well, it must be funded by equity. You think about the formula, assets equals liabilities plus owner's equity. If liabilities fund 53% of assets, equity must fund the other 46%. Now, the debt to equity ratio is very similar to debt to assets, and it pretty much tells you the same thing, but it expresses it differently. Like the debt to assets ratio, a higher debt to equity ratio indicates a riskier capital structure, and therefore a greater risk of insolvency, but a greater risk of profitability as well. The debt to equity ratio is literally what the title suggests, total liabilities divided by total equity. Now, I know that in your textbook, guys, in your entrepreneurial finance textbook, it does suggest that debt to equity might be long-term liabilities divided by equity. Different textbooks use different definitions of liabilities. I like total liabilities, and a lot of textbooks use total liabilities because I think it just encompasses all the liabilities, and it's a much broader measure. So please keep that in mind. Now, the debt to equity ratio is 1.16, meaning that liabilities outweigh equities by a ratio of 1.16 to 1. But we kind of know this from the fact that debt is 53.75% funding assets. Equity is only 46.75% funding assets. So that kind of hints at the fact that you've got more debt than equity. Yeah, these two ratios say the same thing, they express them differently. The times interest earned is the final of our solvency ratios, and really explaining it ends the Lecture 2 discussion around ratios, liquidity and solvency. The times interest earned ratio is a very nice ratio in that it helps banks especially, and helps managers in companies understand how well they may repay, how easily they might, and how assuredly, how much they might be sure they're able to repay the bank's interest for a loan taken. Now, a higher ratio indicates a greater ability for a company to meet its interest obligations, and therefore a lower risk of it going insolvent. That if you're paying the banks are happy. The times interest earned ratio is a very interesting formula which can confuse students. It's the net profit after tax of a company plus the company's interest expense plus its income tax expense divided by its interest expense. What does this mean? Now, your net profit after tax is the final profit figure. A bank doesn't really care about your net profit after tax. Well, it cares. It wants you to have a nice profit. But it doesn't really care about your net profit after tax in terms of its concern as to whether you'll be able to pay the bank. What the bank's really concerned about is what your profit is before interest is taken out, before tax is taken out. Before the government comes in and takes its share of tax from your profit, you've got to first pay off your expenses and use your revenues and, calculate profits by subtracting expenses from revenues. Now, the bank gets its interest before the government takes its tax. So the bank doesn't care what profit after tax is. It just wants you to earn enough profit that it can get its interest payment back. Now, so the bank really is concerned about your profit before tax, before interest expense is taken out. That is your profit after tax, added back your interest expense, added back your income tax expense. Now, mathematically, when you add back an expense to profit, you are getting rid of that expense from profit. We think about this example. What is net profit before interest expense is taken out and before income tax is taken out? It's 99, the amount after tax, plus tax of 40, so it was 139 million before tax, and add back the 22 million, 139 plus 22, it's $161 million. We had a profit of $161 million before tax and before interest. We call this figure EBIT, earnings before interest and taxes. That is the raw profit earned by our assets before the banks took their interest and the government took their tax. Now, that profit figure is the profit figure the company cares about. Sorry, the banks care about, because it's from that number that the bank takes its interest. And that's why the bank isn't too fussed about 99 million. It's nice to know, but what they really care about is 161, that number you earn before they come in and take their repayment. Divide that by the interest expense, and your times interest earned is 7.3182. What does that mean? It means that you can repay your interest bill to the bank 7 times over and then some, 7.3182, based on this year's profits. That's a pretty healthy ratio. And a bank would feel, wow, you can pay us 7 times over. You can pay our interest 7 times over. You're good for this loan. The very worst case scenario, you'll pay our interest back. We can keep the loan going. So it's a measure of your ability to stay solvent by keeping the bank happy. The higher the ratio, the better. But again, let's keep in mind, guys, that ratios that are really high make you wonder whether the company is going too safe. Maybe it could take a bit more debt and give itself the opportunity to earn even more profits. So there is such a thing as a ratio that's too high. Now in Lecture 3, after talking about profitability ratios, I'm going to get into this whole DuPont analysis where we talk about how we combine ratios and make sense of ratios and reflect on this idea that, as I've hinted at in the lecture to date, that higher ratios are not always better, lower ratios are not always worse. It depends on the number and the style of the company. But all that for Lecture 3. Thank you for listening. Keep it up, guys. We're 2 lectures in. Don't be intimidated by the work. Just get stuck in, ask questions when you're in doubt, and looking forward to seeing you either on the Monday drop-ins or liaising with you via Slack or by phone or email, however you want. Have a lovely day, and we'll be in touch. Cheers.